Are you accidentally leaving free money on the table? Most people don't realize their savings are losing value thanks to inflation, effectively shrinking their future. But what if there was a simple way to not just protect your money, but make it grow without constant checking or complex strategies? You work hard for your money, and it should work hard for you too. Many beginners feel overwhelmed by investing, thinking it's only for the super rich or requires a finance degree. The truth is, investing can be incredibly straightforward, even for total newbies. Imagine a world where your money grows almost on autopilot, allowing you to focus on what you love. In this video, we're going to unlock the secret to stress-free investing with something called index funds. These are perfect for absolute beginners. We'll show you how index funds can help your savings catch up and potentially surpass inflation, building real wealth over time. It's simpler than you think to start your investing journey and give your money the power it deserves. Okay, so what exactly is an index fund? Imagine you want to try different foods at a party. Instead of picking just one tiny appetizer, an index fund lets you grab a whole platter with a little bit of everything. It's essentially a basket of many different stocks or bonds that automatically tracks a specific market index. Think of the S&P 500, for example. This index represents 500 of the biggest companies in the U.S. When you buy an S&P 500 index fund, you're not buying stock in just one company like Apple or Google. Instead, you're buying a tiny piece of all 500 companies in that index, all at once. It's like buying a whole pizza instead of just one slice. You get a taste of everything without having to pick and choose individual ingredients yourself. This makes investing super simple. Now, why do index funds truly rock? It all comes down to something called diversification. Imagine putting all your eggs in one basket. If that basket falls, all your eggs are gone. Picking just one or two individual stocks is a bit like that. If that one company struggles, your investment takes a direct hit. But with an index fund, you're not just buying one stock. You're buying tiny pieces of many different companies all at once. It's like having hundreds of tiny baskets. For example, an S&P 500 index fund gives you exposure to 500 of the largest companies in the U.S. If one or two of those companies have a bad year, the other 498 can help balance things out. This spreads your risk dramatically. It's a powerful shield against volatility and a smart way to invest without constantly worrying about one company's performance. Diversification means a smoother ride and less stress for your money. Now, let's talk about something sneaky that eats away at your money: fees. Index funds are champions here because they have incredibly low fees, often less than 0.1% per year. This is called the expense ratio, and it's a tiny slice of your investment that goes to managing the fund. Compare that to actively managed funds, where a human tries to beat the market. They often charge 1% or even more in fees. That might not sound like much, but it adds up significantly over time and directly reduces your returns. Imagine you have $10,000 invested. A 1% fee means you're losing $100 every single year, even if your investment performs well. That's $100 that could have been growing for you, compounding year after year. With index funds, those tiny fees keep more money in your pocket, allowing your investments to grow faster and more efficiently. Low fees are a silent superpower, making a huge difference in your long-term wealth. Now, let's talk about the real magic trick of index funds: long-term growth and the power of compounding. This isn't about getting rich overnight. It's about steadily building wealth over years, even decades. Your money doesn't just grow, its earnings start earning their own money. Imagine you invest just $100 every single month into an S&P 500 index fund. Over 30 years, that's $36,000 of your own money invested. But here's where compounding kicks in like a financial superpower. Based on historical average returns, which have been around 7-10% annually for the S&P 500, that $36,000 you contributed could potentially grow to over $100,000 or even $150,000. That's a huge difference, almost all from compounding. The biggest mistake beginners make is waiting too long to start. Time is your best friend When it comes to compounding, the sooner you begin, even with small amounts, the more time your money has to multiply. So there you have it. Index funds offer a super simple, diversified, and incredibly low-cost way to get your money working for you. No need to become a stock-picking wizard or spend hours researching companies. Your first easy step: look up a low-cost S&P 500 index fund, often offered by major investment companies. Many brokers make it incredibly easy to find them with just a quick search. Then, consider opening an investment account with a reputable brokerage. You can start small, even with just a few dollars, and watch your wealth slowly grow over time. Investing doesn't have to be scary or complicated. It's about taking that first step towards a financially smarter you. For more easy money tips that make sense, hit that subscribe button.